Okay, so well, I'm the warm-up guy today, so please sit back, enjoy, turn off Facebook, whatever it is you need to do to focus, because today we're going to discuss some of the benefits of using order flow in trading. Now, there are people here that will be new to order flow, and this is also going to be a refresher for those that are using it and maybe need to take a step back a little bit and kind of decomplicate it in their head. I'm going to keep it light on trading jargon and terminology. And I would prefer to hold the questions till the end, as we should clear most things up as we move along. But our goals today, basically, very simply, understand what order flow is, understand how you can benefit more from order flow yourself in your own situation, and then understand how you can start to introduce it to your trading step by step. And I know that traders love to kind of run before they can walk, but it is important with order flow to try and just take it one step at a time so that you don't have a lot of confusion and you really squeeze the most out of each benefit before you move on to the next. So, I could give you 50 benefits of order flow, some that would be very easy to implement, some that would be quite difficult to implement. There's no point in trying to do lots of things at the same time. So we like to do it, we like to get one benefit and lock that in. And then once you've got that locked in, let's move on to something else. Now, the majority of retail traders trade off levels, in many cases trying to determine a point at which the market's going to turn around so that they can capture the majority of the move. Now, we're not going to really go into the wisdom or not of that in this webinar, but I call these levels major reversal points. Now, other traders are looking for market to establish direction before looking to get another pullback, and I call those minor reversal points. But whether it's a major reversal or a minor reversal point, you're looking for a level to trade. Now, obviously, there are traders looking to capitalize on short-term ranges, fading the extremes, but even those traders, they're still looking at the levels, the extremes, and the ranges. Now, the smarter traders are actually doing both, so adjusting the technique based on the level of activity or participation in the market overall. And we'll have a talk about that at the end, because it's one of the questions that I get the most from traders is they say, I've got this technique, it works brilliantly 4 days out of 5, but on the 5th day I give all my money back. And recognizing recognizing fully themselves that that's because the conditions were different on that day, just not being able to tell that in advance. And we'll cover that a little bit at the end. But anyway, what we see with most traders, they all generally have one thing in common, and that's that they look for levels to trade off or levels to trade around. And the dilemma with levels that traders face is actually quite simple. We could turn at the level, we could turn before the level, we could go through and then turn around, or we could just run straight through. So if we wait for the level to be hit, we're obviously going to miss the opportunities where the turn is just before the level. If we always trade just before the level, so we can, we get the early turns, then we're going to have quite a big stop if we want to avoid getting stopped out when it turns later on. Okay. Now, one of the solutions to this dilemma is you could actually scale into a position. A lot of traders do that, and there's nothing wrong with that. But there are ways to refine the entries, so you actually just enter at the right time. So order flow gives you the opportunity to fine-tune entries by looking at the activity of traders as we approach these areas. And it also helps you to analyze the behavior of traders after you enter a trade to help you decide whether to stay in the market or not. And obviously, a lot of traders are so focused on getting into the market that when they're in a trade, they're just kind of hands off and don't know what to do. So the skills that help you decide whether to enter a trade or not are exactly the same skills that you use to decide to stay in a trade. Okay, so there's no real difference in reading the market in those two scenarios. So, you may well, for instance, have the market move against you after you get into a trade, but the order flow is weak, so you just stay with the trade until kind of the market's shown its hand. Now, order flow analysis and tape reading are just two different names for the same thing. So what you're doing is you're watching the flow of orders and the impact of those orders on price to see how market participants are acting and where they might be getting trapped. Now, many novice traders have got this tendency to go out and try and find some mechanical signals, combinations of fixed factors or indicators that give them a red light, green light, and effectively absolve them of having to make a decision. And the theory is that that's the easy way to trade, but the reality is the markets really aren't like that. They're not really mechanical. And if they were, you'd still have billions of combinations of fixed factors and indicators to find that one magic signal that works in all markets, in all time frames, and all conditions. And that's one of the reasons that many people spend 5, 10, 15, I've even met people with 20 years in of trying to trade and not getting anywhere. Now, order flow is a bit different. It's a discretionary skill. And if you bring order flow into your trading, you have to embrace that fact. But the word discretionary, a lot of people, they hear about discretionary trading and they think you're just sitting there with a baseball bat, whack, 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 just whacking into trades and having to trade all the time and always know what the market's going to do. And it's really not like that. So discretionary doesn't mean no rules. And there's also no law that says a discretionary approach is more difficult to learn than a mechanical approach. In fact, the process of working your way through hundreds and hundreds of mechanical or purchase systems that don't work, it's a little bit like trying to find a needle in a haystack. It's all or nothing. It works or it doesn't. When you look at discretionary trading, you're actually developing a skill. So the progress you make is actually in steps and it's measurable if you take the time to measure it, right? If you don't make any notes or use any tracking system, then of course it's not measurable at all. But order flow is like reading a story. And all stories are different, but stories all use the same language. And it's the same with order flow. Order flow is simply an activity in the market that's got its own language, and that describes the behavior of traders. So a good example of this, and the sort of behaviors that we see, just imagine a market where sellers are dominant and price is moving down to a level of support. And as you get to an area of support, you might see one of the following. Oh, we kind of dropped off the bottom of the slide there. That's good. So we might see, for instance, we move down. We've got all these big sellers here, but as we move down, all the large sellers disappear. They're no longer participating, but the market's still going down on small retail participation. So what we'd see in that scenario is that the behavior of some of the participants is changing. We might see that we get to our support level, and sellers are hitting aggressively with large size before, during, and after we go through that price. And what we're seeing there is no observable change in behavior. We might get to the support area and we find that nobody wants to sell at a certain price. This is very, very common. So we often get to price, nobody wants to sell it. We retrace a few ticks, go back to the price again, nobody wants to touch it. And there's a clear and observable change in behavior, a lack of commitment to trade at one or more prices. Another thing we might see, we get to the area of support or where we think support might be, and the sellers keep hitting aggressively into that market, all this selling, but the market's no longer reacting to that selling. It's no longer moving down. And what that means is the sellers are stuck, they're trapped offside. So there's a considerable amount of selling, but no move down. It means those traders are stuck. Doesn't mean the market's always going to reverse, but it does mean in that minute that those traders are stuck. Another thing we might see, we get to our area of support and it suddenly ticks up with large sides, obvious buy side aggression, buyers initiating a new move up. So when it comes to reversals, we have three things to look for, right? We have absorption, which, and we're going to talk about the market one-sided. I'm not going to say and reverse for long on everything I say, but absorption is basically where sellers keep selling, but the bidders add to their bids and absorb all that selling. And often this is known as an iceberg order, but there doesn't actually have to be an iceberg order for absorption. But absorption just means, you know, people are still selling, but the selling is no longer getting anywhere. Somebody's absorbing that selling. Okay, so that's the first element of a reversal. Second element of reversal is the seller fade. And it's just really where one side gives up. There's kind of a pause in the action and just nobody wants to trade into a particular price. Sometimes it's just kind of, it's almost amusing what happens. You know, you see 300 trade and it ticks down, then 500 trade and it ticks down, 800 trade and it ticks down, and then 12 trade. And it ticks back up and you get back to that price and then 20 trade. And it's just such a big difference between, you know, the big numbers you're seeing on the way down and just suddenly nobody wants to touch it at all. Okay, sometimes it's not so black and white, but sometimes it is quite comical. And then the other element of reversal is when buyers jump in, where, you know, the other side start to push the market against the sellers. You usually see an imbalance of about 1.5 times to 2 times buyers to sellers when the market turns around like this. Now, This is all well and good, 3 things you see on a reversal, but how often do you actually see one of those things or a combination of those things in a reversal? Well, the funny thing is that's the wrong question, okay? The question actually you should ask is, how could a reversal occur without one or more of these things? And the answer is it couldn't. It would be impossible for a market to change direction without one or more of those 3 things happening. Now, some things are easier to spot than others. Absorption, seller fade, very easy to spot. Buyers just jumping in can happen after 1 or 2, but sometimes it just happens from nowhere, which means it's a little bit harder to spot. So on any reversal, on any market, you will see one or more of these elements, and a reversal cannot occur without them. So exactly where is it you look for these things? Well, as you know, these aren't things that you look for in price alone. So price, when we look at price charts, it's showing us the result of trading. It's showing us where we traded, but not how we traded. And that brings us to just one other aspect of order flow analysis, and that's using the volume profile to understand where the trades are positioned. So consider this image for a second. Okay, we have a high here and a low here, but the volume profile that shows where people actually traded the most, where actual positions are, shows a very different story. It shows a market where the majority of positions are in this area, and where we've actually had moves, these little moves up and down have just been low volume probes either side, but with the low volume above and below, there's absolutely no sign that any of these traders that are positioned in this area have actually been stopped out. So somebody looking at this particular volume profile would instantly know a few things. They'd know that the majority of positions right now are in this area here, that there's no evidence that any significant amount of traders positioned in this area got stopped out when we moved up. And we know that. We'd have known that by 2 things. First, the speed at which it moved up, but just by the number of contacts that traded there. So as such, anybody looking at the volume profile would know or presume that actually if we start to tick down here, it's very likely it will go back into the range and probably hit the other side of the range as well. Now, if the volume in this upper probe here was a lot higher, a lot more volume of price, we would actually surmise that some of the shorts in this area have been stopped out. And with that one difference, it now becomes a lot more likely that when we come back to this area here, that we will hold. And that is based on nothing more than a fairly basic understanding of how people feel and behave after losing money. Now, I'm not going to go into the different ways we'd interpret the volume profile, but I will just say one thing. If you imagine you've got longs and shorts in this area, and then we pop up and the shorts in that area get stopped out. So a lot of the shorts in this area get stopped out. We have the stop run up. What's going to happen to those people that were short there when we come back to this area? And the answer is they're probably not going to sell again. Okay, because if you just lost money shorting an area, when the market comes back, everybody can see that people lost money shorting that area, and the people that did short it can feel the pain. So when you come back to an area like this after a stop run, you'll be amazed at how many times it holds the tick at the top of this volume area, purely because there's kind of an imbalance in emotion when you get back to that area. Now, I'm not going to, as I said, I'm not going to go into all the different ways you would interpret the volume profile. It would take a few hours. But even to those who've never used this, it should be fairly obvious that this price here with 22,000 contracts is far more significant in terms of short-term future action than this price here with 23 contracts, right? There's more positions here. There are more traders whose reaction can cause a move in the market at this price than at this price here. Now, the other thing order flow analysis looks at is the behavior of resting orders or limit orders in the market and how they're being manipulated, either hiding their real intent or putting in large orders to deceive you into thinking that the market is stronger or weaker than it actually is. So we often see iceberg orders where only a small amount of liquidity is shown, but the actual supply or demand is much higher. We also see spoof orders where orders simply disappear when price gets close to them. And this view of the market, when people see this, they kind of freeze up because there are so many numbers on it, right? But when we're looking at the bids and offers like this, generally speaking, we're not looking at all the numbers. We're just looking at the way this moves up and down and just looking to see if there's any outliers, right? Now, it is true that some of the activity of this pulling orders, spoofing orders, did become illegal. And unfortunately, it didn't actually change anything. The only people that seem to have been got into trouble for spoofing have been spoofing with very, very few contracts. So if you go and look at the treasuries, you know, the US Treasury futures, you'll see that spoofing is still very, very much thing. That the order book is still very, very heavily manipulated. Now, you can also see bids and offers graphically, right? So you can see bids and offers here on the Jigsaw dome. And you can also see them here on the Vista chart. You've got the bids below and the offers above. So we can see here a huge bid at the bottom here, 51.97, 629 contracts, and also very big there. Absolutely massive relative to anything else on the screen. Still, it's the trades and the positions that are the most significant. So if you compare trading to a poker game, showing a large bid is a bit like showing your cards to the other players. It's actually pointless to show players your cards unless you want to plant the seeds of ideas in their head and you've got some sort of double bluff going on. So the bids and offers are always, without doubt, suspect. And it's what ends up trading there that is most reliable. So the way you need to think of these bids and offers, these big orders here, is that they are a heads up. Right? They're telling you somebody's interested in those prices, but it doesn't really tell you what they want, that they're trying to do. So if you just see these orders here and trade in front of them, a process known as front running, that's going to be a net losing strategy on its own. But there are scenarios when you can do it. But, you know, in the interest of keeping this discussion short, we'll leave that for another day. But if you are interested, there are some videos on the Jigsaw site that talk about front running and the times that you can actually trade in front of these orders with a fairly high probability. Now, if anybody's confused, what I would say is there's a lot of different things we've seen there and a lot of different concepts. But don't think of all these things as different concepts or different techniques, right? Order flow is just information, right? Don't think you need to master all of those concepts before taking the first step, right? So you read your first price charts. Most likely you could read a price chart before you added all your Ichimoku clouds and Fibonacci's and all that kind of thing. So with order flow, the tools, any order flow tool is just based on a common set of concepts. And we've just gone over them in a few slides. But basically, you need to think of order flow in the same way you think of price charts. Order flow just presents certain information. Okay, order flow is just certain information, and the order flow tools just present that information in a logical manner. So like price charts, there's a lot of different ways to use this information, but there isn't just one way to use order flow tools, right? But there is one thing everybody new to order flow has to do, and that is to keep it simple. Because a lot of the people that come to order flow, they do so because they've gone through this process where they came to trading, they saw the price charts, they added more and more indicators to the chart, looking for that perfect combination of indicators to tell them where to get into trade. And they added more and more things to their charts, but not being able to make a decision. It's analysis paralysis. And part of the problem is that every indicator they add is just slicing and dicing the same information, the price. So if all your indicators are based on price, then you're still just trading price. There's a lot of bells and whistles, but they're all basically dissecting the same information. So as traders progress, they realize that more is not necessarily better. And over time, they drop the majority of their indicators and keep their chart simple. And then many of these traders that saw the wisdom of keeping their chart simple, they make exactly the same mistake when they adopt order flow. So instead of keeping it simple, bringing in one or two order flow concepts at a time, they find every order flow indicator they can off the internet, add them to their screens, and end up with exactly the same analysis paralysis. So it pays to keep things simple and not turn this into a science project, right? The professional traders that use order flow also did it one concept at a time. Nobody can learn 50 things and juggle 50 things around in their head when they're starting out, right? So you keep it simple, and if you keep it simple and follow a well-worn path, you will see progress in hours when you adopt order flow. Now, that doesn't mean you will become an expert in hours, but it does mean you're going to start to see patterns emerge after just 5 or 6 sessions of watching the order flow. And the best way to look at order flow, it's not really as an all or nothing thing. There are beginner and advanced techniques. There's entry techniques, there's management techniques, there's exit techniques. You can use it in very short-term day trading. You can be in the market for seconds, or you can use it in long-term day trading in the market for hours. So the way to do it is you first choose a benefit, a focus area. You get the most from that benefit first, and that means, yes, real measurable improvements in your trading performance. And after that, you move on to the next benefit. What you don't try and do is cram 18, 20, 30 hours of videos into your head and try and become an expert in all techniques in one go, because as keen as you might be, it will not get you where you want to get any faster. So I've seen people try and do this and jam so much information into their head, and after 6 months come back to me and say, Pete, I just don't get it. And I say, did you try the video I told you 6 months ago? Just that for 1 week, nothing else. And they say no. And then, okay, try it, give it a go. You just spent 6 months and not go anywhere. And I get a call a week later. Okay, now I see it. Okay. So for many people, the best place to start with order flow is trade management, which is the ability to cut your losers very quickly and let your winners run. And that's based on something we call momentum reading techniques, which in turn you can learn by doing a few drills for maybe 8 or 9 hours, 8 or 9 1-hour sessions, doing some drills we give you. You will become really good at spotting momentum, which means you'll recognize when momentum's on your side and you'll recognize when momentum's against you. And guess what? When momentum's on your side, you stay in a trade, and when momentum's against you, you get out of your trade. Okay, that is not rocket science, right? But it is something that's very, very useful, and something that once you learn it will stick with you forever. And it's something where you will make major leaps forwards in a matter of weeks. So let's have a high-level view of what's important. With order flow, you're really interested in 2 things. You're interested in what happened before and what's happening now. And it's the right now that is kind of more important, that has priority. So in this image from the 26th of February, we can see earlier on in the day, we got some traders stuck here. And this is a few minutes after the open of the S&P 500 futures. The X's here represent an area of high volume from the overnight session. It's just something I put in there manually because it's one of the trades I take, is trading off the high volume from overnight. It's an area that the market often holds in the first few minutes of the S&P 500 area. The colorful column here is the session volume profile of the new session that's just opened. Now, in the center of the Jigsaw DOM here, we've got something called current trades, which just shows you what's trading right here, right now, this time round. So if we leave an area and come back after a few seconds, that's going to reset. So what we can see here is that buyers have bought 690 contracts, which is a lot for this market on this day. It did tick up and trade 57 contracts here, but it's not really able to get any more momentum upwards. Now on the tape here, we look at the larger trade. The tape here is just showing the larger trades. It is mixed, but we can see the market did move up from the open, and we can see we've still got large buyers hitting the market, but not getting anywhere. So we're at an area where the X's are that we expect a reaction. We've moved up, but now we're stuck. And we're stuck because the buying is still there, but it's no longer causing the market to move up. So what can we do? Well, we can sell it. And here's the beauty of this particular sort of seller. We are now leaning on the fact that buyers are stuck at this price here, which is 27.60, right? That the market can no longer move up. So where's our stop loss going to be? Right, just above here, 3 or 4 ticks at most. Target, well, we're just at the open, so we're on one of the opening swings. So the target's, infinite almost. And that's the beauty of many order flow setups. It's a closed stop and a great risk reward ratio. So now you can see a resting order to sell here, but that is not going to get hit. The market's stalled. So think about this, right? I'm here at position 149 in the queue. At 60.25, 57 contracts traded, and we move back down. So I can see that the buyers are trapped here, right? And that this price just below my order, there was very little interest. So what the order flow is telling me there is, yes, this market is probably going to move down, but no, I'm definitely not going to get filled at this price. So the choice you've got here is to miss the trade or get in at the current price. It goes back to what we talk about trading levels, right? This is an example where we moved early. So what we can see is the market then marched down, and you can see on the current trades, it's mostly sell market orders on the way down. Okay, so we can see here the quantity of sells versus the quantity of buys. So it's mostly selling on the way down. And now we're at the bottom of this area that we marked out on the volume profile. So again, a place where after the open there's a high probability we're going to get at least a bounce. Okay, so I took the first bounce because the market moved up to this the top end of this area, and now I'm a bit wary because we're at the bottom end and there's a chance the market could stall here. Okay, so the market moved down. We can see predominantly sellers on the way down. We're at the bottom of this high volume area. What do we see? Well, we see in here the same thing that we saw at the top earlier. We've now sold 672 contracts here, and during that same time only 252 buys. Now if you look at the bids here, there's 119 contracts bid or 119 buy limit orders. In fact, all the time that we traded here, there were only about 100 bids showing, but we traded 672 contracts. So we had 672 sells, but at any one time there were only 100 buyers. So what happened was, as we traded, the bidders were quietly adding more contracts. In fact, at this point, 710 contracts have been added to the bid while we traded here. So what this is showing us how many contracts the bidders added while we were trading at that level. So if you've ever heard of an iceberg order, this is an iceberg order. So a seller sold, the bidders added bids, slowly trapping those sellers. So not only are we not making progress down, not only are we not an area where we think the market's going to stop, but the buyers are being a bit sneaky. They're hiding their size, but they just can't hide their size from us because we're actually looking at the order flow information. Anyway, before we move on, remember the 3 contracts here and the 672 at 57.25. Because if you look, you can see that's as far as we got. We just traded another 11 contracts at 57.25, and nobody wanted to touch 27.57. And the market lifted up, and we can see that on the way up, we got more buyers and sellers. And guess what? We've moved up. What are we seeing? We're seeing another potential trap, but this time it's 1,076 traders that bought at 27.61. So again, we've got 1,000 buy market orders. Market didn't move up. Now we're not going to keep going over these because it's kind of like, you know, once you've seen like 17 of them, you probably had enough. Okay, but we've seen enough of the S&P. We'll look at a more volatile market, but you get the picture, right? We're leaning on areas where the market is temporarily stuck for entries and exits and trades that have got really good risk-reward ratio. On trades like this, you don't have to be right even 50% of the time, right? Because of the size of the move and the size of your risk. And these are also trades that are common sense. They're not based on some abstract concept. They're not based on horoscopes, moon phases, Fibonacci, or anything else that's a bit mystical that you have to take on faith. So this is based purely on buyers are stuck here and they're going to sell in a minute, right? Because the market's going to move against it. Anyway, let's look at another common sense setup, and this time on crude oil. Now, what we see here on crude oil, something very common with thinner markets, more volatile markets, we call a volume spike. Now, you've all seen these. The market breaks and runs in one direction with huge volume, right? You see the market break. You didn't get in. You feel like you're missing out on something huge until you just can't stop yourself any longer, and you finally sell, and that's the low of the day, okay? We have all done this. We all know the excitement and fear of missing out, and then the feeling of getting caught at the end of a move. So we should all be able to appreciate very well how the traders trapped here at the low field, right? It's scary, right? It's not a great place to be. What's also scarier though is actually buying this, right? So these guys sold it. The guys who are trapped here, these circles represent an area where there's excessive size, where people are trapped. They sold it, but even knowing that they sold it at the low or what's potentially the low, it's still kind of scary to buy at this point. Okay, but not so much if you use order flow. So these fast moves often end up with a large clusters of positions, which is what the circles show. And what we can also see below, we can also see a pretty big bid, which is kind of giving us some more support for our trade. A lot of contracts bid at 51.97, but the bids aren't so important. What's important is these positions, real positions from real traders, really feeling like they may have sold the low. So it's a real make or break point. Now, once this market starts to push up through these traders' positions, they're going to get stopped out, and those stop outs trigger a push to the upside. Okay, so you're going to see when the market spikes like this, you're going to see little volume clusters all the way down on a volume spike. You know, there's one here, but the key is when you get one of these volume clusters and the market starts to push up through that area. Okay, you don't buy it just because you see the large amount of volume. I told you order flows like reading a story. I'm going to see this first, and then I see this first, and then I see this next. Gives me a high probability trade. So if this market doesn't push up against those traders, you've got no trade. If there's no cluster of volume to trade against, it means there's nobody to get stopped out. There's nobody whose stops are going to help you in your trade. You've got no trade. If you have both, it means that sellers are getting stopped out, and that causes more profit taking from the people that sold but didn't get out yet. So the people that sold all the way down here, when these guys get stopped out, the guys that sold on the way down, they're also going to think, well, I'll take profit now, and they buy just like the sellers that got stopped out here buy, and people buy, and it just creates this cascade of buy orders, and the market starts to push up, and then it gets to a point where everybody says, well, you know what, path of least resistance is to the upside now, and the market's fully reversed. So we've all done it. We've all seen a market break out like this. It moves some more and more and more, and we see it move. We feel we missed out on this huge move. Looks set to go on forever, but the moment we get in, it's the end of the move. Okay. So like I say, you know how these traders trapped down here feel, because you, I, and everybody else in this room have been that trader. Okay, so it's the same concept, right? Understanding about other traders' positions and them getting caught out. So this is something most of you should be able to relate to, right? If I ask you, why should a Fibonacci level hold? You'll say, well, it's snail shells and leaf patterns, and okay, but why should it hold? Well, it's a number in nature. I ask you why 3,000 traders are stuck. Why is the market going to hold? Because 3,000 sellers tried to sell, didn't get anywhere. There's somebody big holding that market. You can relate to that. You can understand that. It does not require any other explanation. It's kind of the inner layer of the onion you've peeled. Okay, so you don't have to learn strange abstract skills. Just have to draw on your own experiences. Now, of course, not all order flow is about getting caught out, but it's always about other traders, about concepts you can relate to. Not like, you know, when this line crosses over that line, which tells us nothing of the actual behavior occurring in the market at that time. So the common theme then is that it's all about other traders, their positions, their fear of loss, them protecting their winnings. So where do you actually start if you want to add these common sense techniques to your trading? So our recommendation is actually build on what you've got right now. Okay, so you can start off refining your trade entries, or using momentum reading techniques for trade management, or using it to scale into trades when you feel you're on side. But whatever you do, as you add the more and more techniques, you're going to be building on your foundation of knowledge. You're not going to be starting again with each new technique, right? This isn't where you buy a method, you scrap it, you buy another method, you scrap it, you buy another, and you don't move forward. This is actually layering on more and more knowledge and more understanding about how other traders behave. So our recommendation is always to start from where you are now and try and salvage what you've already learned about trading. So we would rather you keep what's working right now from your trading than start over again. Of course, if you're trading moon phases and the color of your favorite morning show presenter's shirt, then obviously you might need to rethink about how much you can keep from that. So everyone's different. And when we meet traders, they come to us with different levels of experience. So we're quite happy to have a quick call with people and just help them figure out what to focus on first. So I'll just go through some typical changes that traders new to order flow make when they actually start using it. So first off is reducing the size of your losing trades. Now this is kind of counterintuitive for a lot of people, because a lot of people are so concerned with where do I get in, where do I get in, where do I get in, where do I get in. That's all they want to know. They're not interested in trade management, right? But this is actually one of the simpler things to do with order flow. All of you watch price after you enter, but the addition of the order flow, it really helps you improve your decision-making process. So for example, you might see price move against you, but with very even maybe low trade, low volume. There's no imbalance, there's no aggression on either side. And even though price is moving against you, you're not really at risk. There's no momentum in the market. It's just milling around up and down. On the other hand, if you see the market move against you and the volume's really good and there's a real imbalance, like you're long and there's twice as many sellers as buyers and the market's really ticking down, your stop's going to get hit. Your stop's going to get hit. There's no point waiting for that to happen. But, when you see that kind of real momentum against you, you get out early, and if you can just save a tick on all of your trades, it will make a lot of difference to your P&L by the end of the year. There's also techniques for getting out of trades that go your way and then initially fail. So, one of the rules I've got is when the market gets to 4 ticks profit on a trade on the S&P, I set my stop to break even. And then when it gets past 4 ticks, I move my stop further away again. Okay. So I might have, so if I've got an 8 tick stop, my stop becomes break even at 4 ticks, and then I move it back to 8 ticks once I get a fill at 4 ticks. Because in my experience, if you can't get 4 ticks on a position, it starts to go back against you. You should just get out of the trade, right? So with an order flow setup, you should be getting a pop. The market should pop your way, 6, 7, or 8 ticks. And if it just lazily moves 4 ticks and then starts coming against you, to me, that's just a wash trade. It's just better to get out of it. Right, so it's not just as simple as it's going against me or going my way. It's also, it went my way and it's really weak and it's just not managing to really get anywhere. So that if it comes back, there's a good chance the momentum will come in, and sometimes you just get out before that happens. But basically, we're utilizing the most basic order flow technique, reading momentum, and as such, you should be able to see significant improvement reading momentum in a fairly short period of time. Now, the other thing is, traders that watch only one market, state of the market is very important. We mentioned it earlier. Traders that watch only one market are at a serious disadvantage. So markets have a higher chance of follow through if they're moving together. For example, if you watch the Dow Jones and the NASDAQ when they're not moving together, the S&P is usually range bound. And that changes throughout the day. So every week I have traders email me saying, my technique works in some market conditions, but not others. And they're just not able to tell when the conditions are changing. And it's because they're trying to assess that by just using one market. And you can't, it's impossible. You have to use correlated markets to really understand the true state of the market overall, right? And in some cases, you just stay out of the market when the related markets tell you the chance of follow through is low. Now, of course, refining your entries, everybody wants to do this first, and it is a must for all traders, but it is just a slightly more difficult skill to learn. So for some, there's a bigger change to be made than just getting a better price. It's in understanding that sometimes a later entry at a worse price is a much better trade. So sometimes it's better to let other traders reverse the market, give you confirmation that we have a new direction, and then get into a much higher probability trade. And then after a while, you're going to see things in the market you never saw before. This is something, once you start watching it, it helps you really keep focused on the markets, and there's always something going on. So this is much more engaging than trying to watch a candlestick chart, right? Because there's always something happening. So as you watch this, you'll actually see other pure order flow setups in action, and eventually you'll gain the confidence to trade those too. And to do all these things, you really need nothing than a set of good order flow tools and just a step in the right direction to just take things one step at a time. Now, of course, we do know there are people that bring nothing to the table at all. So traders that have got nothing to refine, nothing that's even been close to working so far. And for people like that, we actually have what we call an institutional course, right? For the people who have got something to improve, we've got a whole bunch of free educational resources that help them get to where they're going to need to be. But for the people with nothing, we've got our institutional course, which is straight from the trading floor of a proprietary trading firm in the City of London. Now, don't worry that you don't have anything to improve, because this course will take you through recognizing different market conditions with 19 setups categorized by those conditions, along with the order flow trigger that gives you the entry signal. Now, there's nothing like this available anywhere else on the market. A professional trading course created by the firm that taught some of the most profitable traders in the City of London. So there's a path for you regardless of where you are in your trading. But we don't just stop at tools and training, because in the thick of all of that click, click, click order entry, it is quite tricky to understand where your profits and losses are coming from. So the Jigsaw analytics come free with the tools, and they break down your trade history and profits by instrument, type of trade, time of day, account, day of week. So you can track both your overall performance, but also find out which behaviors and trades are really working for you. Like this guy who's doing really well overall. We've got a P&L of 30,000 for the current month, but he really shouldn't be trading on Friday. That's a net loser for him every month. So while it's good to have an intuitive feel for whether you're improving or not, you can accelerate your progress with good analytical tools, finding patterns that you wouldn't see in the heat of the battle. You know, it's a bit like panning for gold. It might look like dirt, but there's often a few nuggets of gold in there. Okay, we'll do the Q&A in a second. I've just got a couple of things I want to take you through. Now, the techniques I discussed today are all used on a daily basis in proprietary trading firms. In fact, we work very closely with the firm in the City of London to provide the educational products for our traders. Now, I'm not going to give you a big sales pitch because, you know, have you visualize yourself, you know, with your supermodel girlfriend standing by your Ferrari, you know, that you've loaded onto your lot, I'll just simply say this. If you're sick of being told where to get into the markets and not why you're getting in there, and then seeing those techniques fail, this is something you should give a go. Something where within a couple of weeks, you will drastically change your understanding of the markets with things you can see for yourself in real time, not things you take on faith, things that you see for yourself. So you just choose the package that suits you, whether you're looking to refine what you've got or you're looking for a fresh start. And if you do sign up today, not only will you get the tools and the educations, we'll also make sure you're on the right path with our roadmap calls. And these calls are one-on-one calls, and they're intended to answer any questions you have, but also to make sure you're taking an approach that actually has a chance of success, which means looking at what you do now, figuring out what you should look at first, what steps are right for you, what you should look at second, to really leverage your own knowledge and experience, you know, including choosing the right setups and markets to focus on. Now, we don't have unlimited capacity for this, so this is for people that sign up today only. This will not be available tomorrow. And finally, just one other thing that we'll be giving you today, and this is because Traders Talk twisted our arms into giving you a special deal. We do have a $100 discount on both packages. And again, this is just today. And so you want to sign up, try and sign up for this tomorrow, it will not be available. So all you have to do is go to jigsawtrading.com/traderstalk to sign up now. And we could be having our first chat to transform your trading over the next few days. So let me just have a quick look at the questions. We've got a couple of minutes left. Which time of day is the order flow reading more reliable on the S&P? I would say quite often, you know, 8 a.m. onwards, definitely from 9:30 to 9:45, there's just some very specific setups to look for. And so I wouldn't say it's an easy read then, but there are some specific setups. And then generally for, you know, the first 90 minutes, then it goes quiet. Then when it goes quiet on the S&P, it doesn't mean there's no opportunity, but it just means the opportunities are quite different. It's more like market making opportunities that you should be looking for at that time of day. It's not really opportunities. It's opportunities where you are scalping for fairly a small number of ticks. Similarly, if you look at a market like crude, that really kicks off a little bit earlier. It's got a much wider range, a market like crude, of times when it's good to trade. Certainly, you know, even in the European session, crude's a good market. The S&P is a good market overnight in terms of like the technicals and where it does turn around. But there's just a really long expanse of time. There's like, you know, 10 hours or whatever it is of time where it could actually put in its move. So while it's a good market, it's just not practical to trade overnight because the move can happen, you know, the action can happen over such a long, you know, over such a long amount of time that it's really difficult to keep focused. Can you show the slide of the 3 elements that must be present? Okay, I'll just go over them. Absorption is when somebody on the other side is absorbing your trading. So you've got people selling, but every trade's a buy and sell. So if somebody's selling, somebody's got to be buying, and then the buyers really step up and start absorbing the selling. That's the first one. The second one is just the sellers fade away. You just get to a price, nobody wants to trade it. And the third one is the other side just jumping from nowhere. So the third one is a little bit trickier to catch, but it usually comes after the one of the first two. So we've gone through the questions. I I'm going to give you a 2-minute break, and I'll hand this back now, and so you can get to your next presenter. So thank you all for attending, and we'll catch you in the next webinar we do.